Hey guys, welcome back to the channel. Today we're going to analyze 5 property deals to see if they stack up or not. We're going to look at different things like capital growth potential, rental demand, cash flow, value add potential, and finally see if we would go for this deal or we would stay clear from this deal. So if you are an investor looking to build out your portfolio and want to improve your deal analysis skills, then this video is for you. For those of you who don't know me, my name is Jathu Srikandan. I'm a buyer's agent for property investors and I buy properties all around the country using a data-driven approach. So if you want to work with me, go to my website propertyframeworkbuyersagency.com.au and book a session with me there. What are the key elements of assessing a deal? Okay, I'm going to look at this from 5 different angles. So the first one is it being purchased under market value, which means that, is it being purchased less than the comparables? Number 2, does it pass all the basic due diligence? I'm only looking at the very basic due diligence here, like floods, bushfire, busy street, just the very simple ones. Okay, does it pass those checks? Number 3, the growth potential. Am I going to expect growth in this region over the next few years? Number 4, the rental demand and the cash flow. Is there a healthy rental demand in this area? And is my cash flow looking good? Will I be able to hold on to this property in the long term? And finally, the value add potential. Can I renovate this property? Can I put in a granny flat? And can I subdivide and build another house at the back? So these are the things that I'm going to look at with all these deals. Okay, now let's start off with deal number 1. Deal number 1 is in Mundingburra. So that's in Townsville. We're going to northern Queensland. We have this property we just sold recently. February 2025 is the sold date. Number 4, Wentworth Avenue in Mundingburra. Now, if you look at this pictures, this is a weatherboard home. And you can see it's absolutely fully renovated. You can see the pictures inside. It's very nicely done. So it's a low maintenance weatherboard home on a 793 meter square block of land. It has 3 bedrooms and 1 bathroom. It was purchased for $575,000. This property, because it has been renovated, can rent out for about $600 per week. Now let's look at the growth potential. I'm just looking at the growth profile of Mundingburra. So Townsville, as you already know, it's a hotspot market. We are well into the growth cycle. So Mundingburra has done 34% over 3 years, over the 5 years 51%, over 10 years 41%. The affordability sits at 27.8 years as per hashtag. Now, what is the growth I can expect here? So Mundingburra is well into the growth cycle, but looking at the supply demand metrics, we can expect some more growth in this market. So there's going to be healthy growth coming here for the next couple of years or so. In terms of the rental demand, you can see that the vacancy rate is really tight. It's around 2% and the property will be easily rented out. I'm just doing a cash flow calculation here. My total rental income from this property is $31,200 and here are my expenses: the interest repayments, property management fee, insurances and the council rate. So with this property, I'm negatively geared by minus $9,909 per annum. Is this property being purchased under market value? If you look at the comparables in this region, no, it's not really purchased under market value. Similar properties are selling around $575, $580. So it's in line with the comparables. Does it have value add potential? Not really. It's fully renovated. You can't really subdivide the property and build something at the back because of the zoning. And the granny flat really is not going to make sense. And as you know, not many properties in Townsville have granny flats. A granny flat, the cost of it is $200,000. It's not really going to make sense to put something there. So not much value add potential here. So the basic due diligence, okay, let's have a look at that. The basic due diligence, it's not in a flood zone. So it's away from a flood zone. It's away from a bushfire zone and it's on a quiet street. Okay, so the basic due diligence passes. Okay, so who will this suit for? Okay, this is a good deal, but it will only specifically suit an investor who wants a low maintenance property and is after short-term growth in a healthy market. Okay, it's going to be a low risk passive investor. Let's move to deal number 2. Okay, now we're going to Rockhampton, to the suburb of Allenstown. So this is a 3-bed, 1-bath, a 359-meter square block. Okay, so a slightly smaller block, selling for 315,000, which looks really good. The price point really looks good. If you look at the photos inside, it's nothing spectacular, but it has been painted. There has been new carpets. The bathroom looks dated, but still a property that you could live in and it could rent out immediately. So it could potentially rent out for $430 per week. So it looks like it really has a really good rental deal. And similar properties are going anywhere between 300 to 350,000. This one has a slightly lower land size. So we might have just got it maybe about 10, 15, 20K under market value perhaps in this instance. But let's look at the basic due diligence checks. This property fails the basic due diligence checks because it falls into a flood zone. As you can see here, it's sitting right in the middle of a flood zone. Allenstown does flood. The second thing is that it's also in close proximity to the Bruce Highway. So being in close proximity to that highway, noise also becomes a factor. I'm not going to proceed with this deal. Even though the yields look good, the price point is really good, the overall deal does not stack up because flood zone being close to a busy road is a deal breaker for me. So deal number 2 does not stack up. Let's move to property number 3. Now we're going to Melbourne. Now this property is 35 Rosedale Crescent in Dallas. If you look at these pictures, again, this is a rundown property, 3-bedroom, 1-bathroom, 588-meter square land, 450,000. So really good price point. You can see the property is worn. Carpets look tired. The carpets definitely need a replacement. It needs painting. The bathrooms are dated, and definitely a property that needs some work. So if you look at good properties in Dallas, similar land sizes are selling for 520 to 550. So even if you factor in about 30,000 for renovation for this property, it sold at 450,000, 30,000 for renovation, sits at 480. So still getting it somewhat under market value here because of the work that needs to be done. It's also a decent sized land here. If you look at the basic due diligence, yes, there's no flood, no bushfire, and it's not on a busy street, and the land is flat, so it passes all the basic due diligence. Let's look at the growth potential here. Look at the graph here. Dallas did nothing since 2018. Okay, the graph is pretty much flat, but we know that the market is picking up. Speaking to agents on the ground, looking at the auctions that are happening, the market is slowly and steadily picking up. We can see the momentum picking up in this market, right? So it is a good entry into the market. Yes, the first couple of years might be a bit slow, but then it will pick up gradually from there. The affordability in Dallas is a bit of a concern at 43 years. But besides that, we are seeing that, once you put in a renovation of 30,000, basic cosmetic renovation where you put in new carpets, new flooring, you paint the house, put in new stuff into the bathroom, like replace the vanity shower. So just basic renovation, which might cost you about 35,000, you will automatically push the property value to 520,000, which is a 70,000 uplift in the equity. And the rents on this property after that renovation would sit around $480 per week. Now let's look at that cash flow, factoring in a purchase price of $450,000 and rents at $480 per week. The vacancy rate in Dallas is really tight. It's sitting at 2%, so easily will be rented out. The cash flow looks here really good. Rental income, and you can see all the expenses here, factoring the land tax as well for Melbourne. It's at minus $6,977 per year before tax, which is really good cash flow in today's market. So overall, to sum up this deal in Dallas, I think we're getting into a market which has been stagnant for a long time. We have the potential value uplift through that renovation, which is really good. So we're automatically getting an instant equity, and then we have the market movement, which is slowly building up in momentum. So I think this is a good deal. It'll suit someone who is willing to take on a bit of risk, because at times renovation costs could be a bit higher than what you forecast. There are delays with it, and of course there is that risk element involved with that renovation. So someone who's willing to take a bit of risk and someone who is actively involved with the property, it'll suit that type of investor. But overall, I think this is a really good deal. Now let's move to property number 4. We're moving to Perth. This is number 22 Eden Way in Baldivis, sold for 650,000. It's on a 464 meter square block of land. As you can see from the pictures, this is an amazing property, fully renovated. It's a new house, so looks to be in really good condition. Is it under market value? No, not really. Similar properties are selling for around 650 to 670, not under market value. It passes all the basic due diligence. There's no flood, there's no bushfire. It's on a quiet street. Now let's look at the growth potential. Now Perth is a super hot market, and what this has been doing is over 3 years 70%, 5 years 117%, and over 10 years 76%. So you can see a lot of growth already in this market. Okay, one of the concern, that supply demand metrics are good for the area, but one concerning things is the increasing building approvals. You can see the building approvals just moving up very rapidly, which means that a lot of supply is going to come into this area. In terms of the rental demand, I'm seeing the vacancy rates just spike up rapidly and sitting at 4.50%. This means that investor activity in this market is really high. The vacancy rates are really high. It will take a lot of time for you to rent out your property. There is a bit of risk here. So overall, while the supply demand metrics look good, the overall deal looks good, there are some factors here which is telling me that it's a high risk. High building approvals, number one, and high vacancy rates. Okay, and combine that with a lot of growth already this market has had, this is not going to be a good deal. I'm not going to proceed with deal number 4. Let's move to the last one, deal number 5. We're going back to Queensland. We're going to Mackay. So this is purchased in Blacks Beach, 34 Whitehaven Drive in Blacks Beach. We've purchased it at 660,000, renting out for $820 per week. Okay, it's a good block of land, 601 meter square, and look at the house. It's a very modern house, newly built. Everything looks perfect with it. It's a low maintenance home. Is it being purchased under market value? Not really, because similar properties are selling for 650,000. Basic due diligence, it's not on a flood zone, it's not in a bushfire zone, and it's not on a busy road. So that looks good. However, if you look at this Blacks Beach, this is the owner-occupier profile for Blacks Beach. So Blacks Beach is essentially split into 2 areas. Okay, you have the north side, which is the older part of Blacks Beach, which is the owner-occupier dominated area, and then you have the southern side of Blacks Beach, which is the investor dominated area. We have the new houses, the new house and land packages, new houses in these areas, and you can see that investors are dominating these areas. So our property is located in a pocket with only 23% owner occupiers. So which means that there are 77% investors in this pocket. So this is an investor dominated area, especially the southern part of Blacks Beach, and that increases risk. Okay, in terms of growth potential, looking at this graph, it looks pretty good. 3 years 33%, 5 years 51%, 10 years 56%. So well into the growth cycle, and there's quite a bit of momentum. The supply demand metrics also look good. There's nothing concerning there. Okay, the affordability is 27 years, so that's healthy as well. In terms of cash flow, the vacancy rates are sitting at around 2%, so really tight. And look at the overall cash flow here, 42,640 rental income, and all these expenses add up to 47,000. So the annual cash flow is minus 4397 per annum, which is excellent in today's environment. Having a cash flow minus 4397 and adding in depreciation coming in from this property is excellent. It might be even cash flow positive, but considering the fact everything else stacks up for this property, but considering the fact that it's inside an investor dominated pocket surrounded by investors, I think it's a bit of a risk. When the market downturn happens, the property values are going to be a bit volatile in this region, and therefore deal number 5 is also not going to work for me. To summarize the deals, we have 5 different deals here. Deal number 1 is the one in Townsville. That's the low risk one, and it's a low maintenance property. Deal number 2 is the one that is in Allenstown. Okay, and this one is the deal breaker. We are not going there because it's in a flood zone. We don't want to buy things inside a flood zone. Deal number 3 is a really good one. That's probably the best deal out of here. The one in Dallas, the one that has equity uplift, and the organic market movement. Deal number 4 is in Perth. I don't want to get inside there because of high building approvals and high vacancy rate. And finally, the last deal, Black's Beach. Everything stacks up, but we're inside an investor dominated area. So this is how you analyze properties, guys, when you're looking at a deal. I hope you found some value in this video. If you like the content, please like and subscribe to my channel, and I'll see you in my next video.